Hey everyone, welcome back to Alpha Insights. I'm Morgan.
And I'm Dakota. Great to have you with us. And hey, if you have questions while you're listening, drop them at stockalpha.ai.
Quick housekeeping before we jump in. U.S. markets are closed for President's Day, so the last trading session was Friday, February 13, and we'll see action again on Tuesday, February 17. We're talking about market data reported heading into the long weekend.
Right. So the name on deck is Ivda. It popped heading into the holiday. And the move caught a lot of attention because of how big the volume was.
The headline? Ivda rallied by about 16% to 34 cents per share, with 199.22 million shares traded in that session, as reported heading into the long weekend. Now, the real question here is, why does that matter? A double-digit spike at a sub-dollar price combined with near 200 million shares changes the risk profile instantly.
Exactly. I mean, when you look at the data, that kind of activity screams event-driven flows or speculative interest. But the tricky part, there wasn't a clear company announcement or filing cited with the report.
Which is the red flag. Without a confirmed catalyst, you're really looking at market flows, momentum traders, maybe a social media push, or an options derivative spillover in similar names. That makes it more fragile.
Yeah, that's a good point.
For traders, though, it can be attractive. Big volume plus big percentage move equals volatility and tradable setups. Short-term traders will look for continuation on the open or quick retracements to scalp.
And to add to that, if you're trading it, be realistic about execution. Sub-dollar names often have wide bid-ask spreads, so slippage can eat up a lot of the upside. Use limit orders, size appropriately, and expect choppy action.
Short reactions. Right.
Interesting.
Okay, let's break down the main risks in plain terms. 1. Volatility and quick reversals. A 16% move can unwind fast, especially if it was driven by short-term traders. 2. Liquidity quirks. That big reported volume doesn't always translate to tight spreads at the times you want to trade. 3. The information vacuum. No filing or press release was cited, so there may not be a durable reason for the move.
That last one is the toughest for buy and hold investors. If you don't have conviction from fundamentals or a formal disclosure, this could be noise.
So what should people watch next? First, watch how Ivda reopens when markets resume. The next session price and volume will tell you whether buyers remain committed or if selling pressure shows up. Second, monitor any SEC filings, press releases, or news that could explain the spike. Third, keep an eye on whether it holds above 34 cents or falls below it. That's our short-term reference point.
And a practical tip, if you plan to trade it, set stop losses and size the position relative to how much pain you can tolerate. For longer-term investors, wait for verifiable catalysts before adding exposure.
Also worth noting, the absence of analyst updates means there's no outside validation in the numbers. So even though activity was huge, outside guidance wasn't part of the story.
Honestly, I was a bit surprised by the sheer volume. 199.22 million shares is a headline-grabbing number for a penny-priced name. That alone can create momentum regardless of fundamentals.
Quick checklist for listeners who want to follow this. 1. Watch next session volume and price behavior. 2. Look for filings or news. 3. Be careful with order types and spreads. 4. Size positions conservatively.
Right. If you trade momentum, there are quick entry and quick exit setups here. If you're a conservative investor, treat it as speculative until proven otherwise.
Let's wrap up with the bottom line.
Ivda saw a sizable intraday move heading into the holiday, about 16% to 34 cents, on roughly 199.22 million shares. But no clear public catalyst was reported. That makes it an interesting but risky setup.
Active traders might use momentum strategies with tight risk controls. Long-term investors should wait for confirmed fundamentals or official disclosures before changing allocations.
Key takeaways together?
Big volume plus big percentage move at a sub-dollar price equals both opportunity and heightened risk.
No confirmed catalyst means treat the move skeptically and watch the follow-up session closely.
And both of us agree. Use proper position sizing and execution tactics if you decide to trade it.
Got questions? We'd love to hear from you. Head over to stockalpha.ai where you can ask us anything and we'll answer live. And while you're there, check out more market content and use the Q&A feature to send us what you want covered next.